Right, so we're talking about diversification now.
Mm.
So let's start off with, what is diversification when it comes to investing?
So at the very crux of it, it's basically just not having all your eggs in one basket. So it's not putting all your money in one asset or one country or one particular fund,
Yes.
because if it all goes wrong, and you might lose all your money. So the whole point of diversification is to try and spread the risk out so that not all your money goes in one direction at the same time.
Okay. So that sounds just very kind of sensible. So what are the different options within that kind of diversified portfolio that you would typically, recommend to kind of people that come to you?
So you can have a real mixed bag, essentially, when it comes to investing. So we use portfolios that have maybe 20 to 30 individual funds in.
Okay.
Certainly they're my favourite, because you get a real mixed bag of different asset classes. So things like bonds and equities, different countries, so US, UK, Japan, and just different areas like pharmaceuticals or technology or AI and things like that. So it's not just diversifying in one area.
Okay.
It's looking at all those different sections and going, right, how can we make the most of this portfolio to spread the risk out and have exposure to as many different areas as possible? Because if the US is having a great time of it, the UK is not necessarily doing the same at the same time, and the same with markets and things like that. So it's kind of hedging your bets against different areas, so that if one part of your portfolio does drop, you've got other parts of it that are propping it up, and hopefully it's not going to drop quite as significantly as if you had all your money in that one place.
Sure. And so what I'm hearing from that too is that if you're taking a long-term approach to investment, so 10, 20, 30, maybe even kind of like 30 years, kind of even longer, having that diversified approach, like you say, when certain things go up and other things go down, does it effectively almost balance it out over the course of kind of time? Is that part of the reasoning of doing it?
Yeah, absolutely. So having a mixed bag approach to investing means that over the long term, you should naturally see positive returns if you're holding your money for the long term anyway. But where you have exposure to different areas, you can then make the most of when those areas are having a good time and you're getting a positive return there. You will get some times when, it's unusual for the whole global market to crash at once.
Yes.
I mean, I won't say never, but we might have had one or two instances of that with COVID and things like that. But broadly speaking, just because one area goes down, the rest of your portfolio should still prop it up. So over the long term, that can have massive benefits, because you're not then suffering these massive drops and then having to climb back up massively. You're kind of having a few drops along the way, but then the returns should be more positive, because you're not having to make such a trek back up to make the money that you've lost.
And I guess investing can sometimes be quite an emotional thing, particularly if you're investing towards retirement or so. Would you suggest, or to what degree would you suggest, that having that diversified approach really kind of helps keeping that emotional investor in check? That, if they wanted to take all their money out of investments into cash each time the market drops 10%, I'm guessing, does that just help people kind of remain invested, gives them a bit more kind of confidence and less prone to knee-jerk reactions, I guess?
I hope so. I mean, investing is very emotional. We've all got different views about investing depending on how our parents used money, because naturally you're just raised in a certain way, or you're very aware of how your parents use their money, whether they talk about it or not. You very much get a feel of how they use their money, or whether they're good with it or not very good with it. So if your parents are spenders, you're probably going to be a spender as well. But if they're the opposite and they're good savers, then you're probably going to be that way too. So it is very natural to just have an automatic response to your money and how you use it. But by having a portfolio that is more diversified, it can perhaps broaden your thinking a bit more, especially if you have an advisor can help you with those decisions. But sometimes people might just automatically say, well, I only want to hold gold, or I only want to hold something else that I can get my head around it, because it can be a lot for some people to think that far afield to understand. If you want to have a look at every individual fund and what it's doing and where it's managed, that can be a lot for some people. So they can automatically just go, well, I only want one fund that I can understand, but then you have that problem of all your money's in one place.
And I'm guessing that if someone comes to you for advice, it would be helpful to take as much of that advice kind of on, if you know what I mean. So if somebody comes to you and says, I only want to invest in gold, it's okay, fantastic. We can weight your portfolio towards that. However, here's what I recommend as an independent financial advisor that wouldn't recommend that for those reasons. So are there any examples of, you don't have to give names, but where you've had maybe kind of like clients or people come to you making those kind of demands where it just hasn't felt right to kind of follow through with it because you know the game much better than maybe they do?
Yeah, I have a couple of clients who partly manage their own portfolio, but then I manage the other part of it because they're quite confident in doing it themselves, or they've worked in the industry and they feel quite confident making their decisions, but they also maybe they want to see if I can beat the market for them, see how if I can beat their returns. And broadly speaking, the answer is yes, I can.
Okay. Cool.
But it can be quite interesting because they weight their portfolios in a particular way, and they're buying or selling different funds because of whatever reason. Whereas I'm taking more of a long-term risk-rated view. So I'm saying, well, that would be too high risk. I wouldn't have made that decision. I would have done this instead, or I wouldn't have made any changes. And it can be quite interesting just to compare portfolios at the end to see which one's done better. But also, clients like that tend to just buy and sell daily or quite often. Whereas that's not my game. I would much rather sit and look at it over a longer time period because, daily changing is not going to get you very far.
Fair enough. Last question on like a diversified portfolio, and this hasn't kind of come up so far. What about cryptocurrency as part of a diversified? Like, okay, 2 questions within that. Is that something that with confidence that you could recommend? And part 2, is that something that more and more people are asking for?
It's definitely something more and more people are asking for, but it's absolutely something I cannot recommend. So it's unregulated in the UK. So as a financial advisor, we're not able to recommend it for clients because there's absolutely no protection whatsoever. You could quite easily lose your money at the drop of a hat, and there's no one you can claim it back on. I am getting asked a lot about it, and some people do like to invest in it, but it's so high risk. It's the most volatile thing that you can have. So if you are going to invest in it, I would just say only invest what you can afford to lose. If you happen to make millions, great, but there's also the chance that you could lose everything as well.
I think this is the thing, isn't it? Is that some of the cryptocurrencies, their actual market capitalization is so small compared to like the FTSE that it would only take what they call like the big whale investors within those cryptocurrencies to start moving money around for there to be some quite significant, drops to people's, I guess, the value of people's kind of investments in them. So if you overnight lose 20% and then the next day it goes down 10% and you're not really prepared to kind of ride it out, it can be really kind of risky for people. And like you say, as an advisor, because it's not regulated, you just can't and you won't touch it.
This is it. And it comes back to putting all your eggs in one basket, because a lot of people just have crypto because they think it's the place to be. But if all your money's in that and it crashes overnight, then you've probably got to wait a long time to get it back or just cut your losses and go. So.
Fair enough. Excellent stuff. So that's diversifying your investment portfolio. Thank you for that. That was perfect.
No worries.
Thank you.